Okay, good morning and welcome back everyone to our Friday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay on a very important day for both American and New Yorker history as we remember the victims of 9/11 and their families. And I want to make sure that everyone takes a few minutes today to reflect on that and make sure that we honor the victims and their families. But we do have a lot to share with you here today as far as where the markets currently stand. There has been a lot of volatility here over the past week, and we want to frame as far as how our views, how we view the current market and what we feel, what our outlook is here for the overall market. A lot of questions over the past week as far as whether or not we're going to see a sustained sell-off as a result of this new volatility that we've seen. Is this the market top that we've all been looking for or seeking? We're hopefully going to share with you our charts and help you answer those questions. But before we do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. Now, I want to talk a little bit about from the perspective of this sell-off and whether or not it has been contained. That was my thesis on last week. On Friday, that was my thesis on CNBC, and that still remains my thesis as of right now. And I want to show you the charts as to why I believe that. Then we'll take a look at the broader market update, some of the individual major indices that support my view here. We'll take a look at volatility and rates, how we have seen some substantial changes here in terms of volatility as well as rates, which show further signs of stabilization to support this thesis. And then I want to take a look at some economic and mobility metrics before we dive into our daily ideas. And at the very end, if we have a few minutes, I will open this up for Q&A. But the primary question that I want to help investors answer is, has the sell-off that we've seen over the past week, is it contained? Or are we expecting to see further downside? I'm actually curious to see what investors are viewing. So if you feel that this sell-off is contained, please type C into the chat window. If you think there's further downside here in this market, please type D into the chat window. I'm curious to see the view here. Okay, so it seems like there's a pretty split view here between contained and further downside. I was actually expecting more of a one-sided view here, but I'm actually glad to see a fair amount of I would say disparity in terms of views, because that usually is good. When views are all one-sided, that's usually when we tend to see big moves to one side. So what I'm going to do today is I'm going to share with you my charts. I'm going to share with you my economic research and the different indicators that I use to determine my outlook on the overall market. So let's go ahead and get started. First off, we're going to start with the NASDAQ 100 index. This is something that I talked about on Tuesday, and two levels that I talked about here is the 270, 250 level. 270 is a level that we basically reached all the way down to on that initial put thrust lower on the markets. Markets bounced a little bit higher back into the 20-day moving average, and now has traded back into the 270 level. But the fact that it's still holding this 270 level is what leads me to believe that this sell-off at the very moment is contained. If we do get an acceleration below 270, that's where I believe that we're going to have initial targets of 260 and then 250 here to the downside. You have a lot of volume from traders that were traded inside of this range. So you have a lot of buyers that are long within this particular price point, within this particular range, and the average price of all of those buyers is around the 260 level. You have all of these buyers up here that have now basically had their losses erased, but you still have a large number of buyers here in this 260 range that are still above water on that market. So that's why I for the moment, I see this sell-off as being contained, but 270 is the important line in the sand here. And arguably the NASDAQ 100 index is the more important index to keep an eye out on here rather than the S&P 500. When we look at the S&P 500, we are now back below its February highs. We're still well above the June 5th highs here. So if we do get an acceleration here to the downside, the 323 level would be my target here to the downside. But again, short term, we're still holding this 335 initial thrust low on that move lower. We haven't broken below that just yet. If we do get a break below, 323 is next. But the fact that we haven't seen this acceleration here to the downside And we're starting to see the market stabilize a little bit is really some of the reasons that I believe that this is contained. Now, we are also at the same time seeing a fair amount of healthy sector rotation. If we look at small caps has not declined as much as the broader market, whether we're talking about the S&P or NASDAQ. It has been far more defensive on this move to the downside. It is still holding this 150 level or so as support. So as markets stabilize, if markets start to resume its march higher, I do expect that small caps will also hold this 150 level. But basically what we have seen is a lot of flow out of technology, consumer discretionary into some of these other sectors. And again, that is positive for the market. We usually think of these as healthy for the market to consolidate after such an exuberant move to the upside from technology shares. It needed to come back to reality to some degree. That's what we've seen so far. And we've seen a bit of rotation into some of the weaker sectors. And that is the healthy market rotation that we're looking for. Equal weight indices also providing protection on the downside here, also holding this 108 support level so far here, hasn't broken below that level. If we break below that level, we head towards into the 104 range here, which is the 200-day moving average. But so far, we're seeing a fair amount of healthy market rotation from these higher beta sectors into more value sectors. I don't think that's going to last, to be perfectly honest. I think that once the market stabilizes, you're going to see flow back into technology, into discretionary. But I do also at the same time think that you're going to see materials, industrials actually perform as well on this, meaning it's not just going to be a one-sided technology driving everyone forward. We're seeing more healthy sector rotation. We're starting to see industrials and some of the other sectors come into play. Now, the VIX 3-month to VIX ratio, this is one that we have consistently looked at as an indicator to give us a better understanding as to the broader views of the markets. And what we continue to see is an improvement here of this higher, meaning when this continues to move lower, that's a risk-off environment. That's where we believe that markets are going to continue selling off. We're not getting that. This has started to reverse higher. This is further evidence that we use to believe that this sell-off here so far is contained, the fact that this ratio continues to improve here over the last couple of days. So short-term markets are not as fearful as longer term, which is good for the short-term investor, especially if you're looking for a containment or stabilization of this market. We also see volatility indices retreat, whether you're looking at the VIX or the VXN, the S&P 500 VIX or the NASDAQ 100 volatility index. Both of those have peaked from that Friday, or I think it was actually Monday when it peaked. I talked about this on the Tuesday morning session where I said that I think that the fact that it got back up to that $48 level certainly does not correspond to the same amount of fear we've had in the markets during this time, and that was a reason to sell volatility. We've gotten that retreat now. The question is whether this will continue to retreat further or we can get an explosion here to the upside. Again, evidence certainly at this point points to that we are going to see a further retreat. When we look at put-call ratios, this was also something that we've been talking about for a long time because put-call ratios historically has almost never spent an extended amount of time below 70. That's the line that I have there. But in 2020, almost a third of all trading days, the 20-day put call ratio was below 0.7. What that means is there was a sustained amount of call buying over a long period of time. Not only sustained, but actually acceleration. That was something that we have never seen before in the history. If going back the 20 plus years that we can track the put call ratio, it has never happened. Only in 2020 have we seen this. This has started to reverse here. The 20-day put call ratio has started to move higher here. As you can see, the current ratio is actually at 0.71. So back to more normal circumstances. The question is whether this will continue to move lower. I'm not certain that this won't continue to move lower. I actually suspect that there's a possibility that this stabilizes for some time and then we still continue to see some further call buying and we get into this cycle again. So just because we've had the cycle doesn't mean that I necessarily think that everything is rosy and that markets are just going to go back to its normal conditions. I still see the same issues that drove this recent volatility in the markets, and I don't necessarily think that that is just going to stop because we had this very quick 2-day 10% correction here in the markets. Now, when we look at the dollar index, this is what's been driving our bullish view here on gold for quite some time. It's been driving some of our bullish euro and Canadian dollar views here on the markets. However, I do want to point out here, over the past few weeks, dollar indexes have continued to make lower lows. Momentum did not confirm those highs, and now we've recently just made a new higher high. What this points to me is that this downtrend here in the dollar, at least for now, is contained. And this also, the stabilization in the dollar also leads me to believe that the sell-off that we currently see is somewhat fairly contained as fixed income markets and dollar markets and rates markets have continued to stabilize. That's what we've seen from the rates market here, the 10-year yield stabilizing here. What looked like it was about to make a big move here to the upside was contained, and we're back into this very narrow range between 60 and 70 basis points here. Likely, I think that we might actually see a continuation to the downside if we look at mortgage rates, if we look at pretty much rates across the curve. We're not seeing any type of momentum here, and that's what I believe that yields are going to stabilize going forward. When we look at the sector rotation, we're still seeing fairly healthy amount of sector rotation. Some of the big moves is that technology has started to move back into the weakenings quadrant. This is something that we haven't seen for a long time. Materials starting to weaken, but still in the leading quadrant. But we see industrials and financials start to move towards the leading side and discretionary start to come lower. This is the healthy market rotation that we're talking about. You want to see some of the strong sectors like materials, technology, and discretionary that have been leading this market start to weaken. You want to see some of the strengthening sectors such as financials, industrials start to continue to strengthen. And as you can see, energy really tried to get into the leading quadrant, but now resuming back to the lagging. So this is one that we pointed out on Tuesday. We started to get a breakdown here on energy. So energy also one of the ones that we're paying attention to. Healthcare starting to lag behind also. Staples starting to get back into the strengthening segment. Utilities also, but real estate coming lower here. So a fair amount of sector rotation going on here in the markets at the moment. Some of the economic indicators I want to point to, we continue to see economic indicators surprise here to the upside as this surprise index continues to gain to the upside in 2020. Ever since the March lows, it just continues to surprise. And this is the surprise index across all of the economic indicators. This is not just a single one or a set of, this is across all of the economic indicators that Bloomberg tracks. We continue to see surprises to the upside. What I did want to show you is some of the big gains that we're seeing in the Q3 GDP numbers. The old expectation was roughly about a 15% gain in Q3. As you can see, that's now been revised to 27%. So we are expecting a much stronger rebound here in Q3 than we were originally expecting, especially with the coronavirus number of coronavirus cases continuing to decline. And now that we're almost at the end of Q3 and we've seen a substantial amount of strength from consumer spending that has remained resilient despite unemployment actually tapering off here, and employment numbers still looking actually not particularly strong, even though we had that really strong job numbers on Friday. But we continue to see surprise here to the upside. If we look at mobility indicators, this is actually something that has started to accelerate here to the upside. This is something that we've been talking about for quite a few months now, how it's been fairly flat during the time where we started to see the significant increase in the number of coronavirus cases, that quote unquote second wave that we saw in the US. We've obviously seen a significant decline in that second wave here over the past few weeks, and mobility indices, real-time mobility indices have started to see an uptick. The one that for me seemed quite is quite encouraging in terms of a real-time indicator is the number of people that are going out to dine, because that is a pretty good, in my opinion, a really good real-time indicator of how comfortable people are with going outside and also at the same time spending money. So open table, seated diners continuing to accelerate to the upside. These real-time metrics give us a pretty good glimpse into how comfortable people feel with getting out there and spending money. And we're seeing this across the whole US. It's not just contained to the areas that have lower number of COVID-19 cases. We're seeing this across the whole board, and that is encouraging. And this is leading to some of the economic surprise that we're seeing, is this continuation of this upward trajectory that is continuing to accelerate. The one downside that we still continue to see, though, is the fact that unemployment claims continue to actually increase. Now, the state initial claims have continued to decline, but the pandemic unemployment continues to rise. So this is predominantly from workers that do not qualify for the state unemployment claims, whether because they're freelance or they didn't have a job before, and for whatever reason, they were able to now get access to the unemployment claims through the federal government, the $300 a week. That has actually increased. So this still leads us to a fairly mixed economic picture. And this is a continuation of what we discussed on Tuesday, which is the fact that the shape of this recovery is going to start diverging depending on your income bracket. For those that are in a higher income bracket, that recovery is looking more and more like this. And on the lower income brackets, it is starting to diverge away. And that's exactly what we're seeing here in this employment number. So lower income citizens are not participating in this recovery in the same way that higher income brackets are. That is going to cause some issues in the markets and continue to cause bifurcation in markets. And that is something that we are continuing to see. Now, if we look at consumer sentiment indices, this is something that we were talking about here over the past couple of weeks, concerned that it was stalling because for quite a few weeks it had stalled. And we were concerned that with the rising number of COVID-19 cases, we're going to see an acceleration to the downside. But instead, we're now continuing to see this improve. We're seeing this across multiple consumer sentiment indices, whether we're looking at the Bloomberg Consumer Comfort Index, the Refinitiv Consumer Sentiment Index. Both have now revisited a new high, relative high since the COVID-19 sell-off. So consumer confidence and sentiment continues to improve, which is a driver of consumer discretionary. And actually what's interesting is that the equal weight consumer discretionary index is actually outperforming the market cap. This is something that we haven't seen for a very long time, because it's really Amazon, Home Depot, and Lowe's dominating that space, dragging the whole market higher while leaving all the other retailers and consumer discretionary names behind. That has started to reverse a little as Amazon and Home Depot have started to pull back along with the NASDAQ 100 index. And then we're starting to see the equal weight index actually start to outperform. So we're seeing, kind of recovery here across the board from a consumer discretionary perspective. So looking at some of the ideas that we have on our radar here. I talked about this on Tuesday, XLE. We talked about the potential breakdown below this 34.5 level. On Tuesday, we did get that move to the downside. Initial move to the downside, came back to retest that as resistance and has now confirmed that move lower. So XLE has confirmed that breakdown. It has retested it as resistance and confirmed that, and now we expect XLE to continue to move lower. Whether you're using XLE as an index to do this or you're using any of the oil names, this is one that we see oil to start continuing to move into the low 30s and high 20s here for XLE. You can use XOM or any of the very liquid energy names to play this to the downside, but I would keep my bets here to names like Exxon, ConocoPhillips, Chevron, those types of big cap names, at least big cap for the energy space. I would stay away from some of the less liquid names if you're trying to play options here to the downside. On the flip side, we have copper prices reaching new all-time highs or new relative all-time highs. And Freeport McMoran, actually one of the largest miners of copper, continuing to see further strength here. We have a bit of a, I would say a bit of a consolidation range that we've seen, a very small consolidation range after a very long rally here. I think that this is the type of rally that can continue moving. Implied volatilities for this stock is also at near all-time lows. So buying call options or buying call spreads here are extremely cheap. That's how I would play this, where you're able to risk a fairly small amount of capital to play for further upside. Copper continuing to see gains as industrial demand continues to pick up, as we see those economic indicators continue to improve and consumer sentiment continue to improve. This gives the confidence for a lot of businesses to invest and start buying these raw materials like copper to produce electronic goods and all different types of goods. And that again is beneficial to names like FCX, which is one of the largest miners of copper in the world. Another one I want to point us to is Uber. Now, Uber hasn't really been, we've been talking about Lyft, we talked about Uber for a long time, but one thing I wanted to point out here, and this is something that I don't do very often, but if you can see, Uber has a very strong downtrend ever since the IPO. We've had this bearish trend line for quite some time, and it looks like we're just about to break out above that multi-year trend line from that IPO price or high of about that $47 or so. So this is one that's on my radar, especially as transports continue to improve here. We're seeing transports continue to improve across the board, whether you're talking about air freight, trucking. So transportation as a whole is starting to see some gains to the upside. And I think that Uber, especially with its recent acquisition in the food delivery space, and we continue to see gains on that front. This is one that is starting to break out here to the upside and could see some substantial moves to the upside. Uber also falls into the category where implied volatility here is extremely low. So buying call options, relatively cheap here to play for upside with fairly limited risk to the downside if this doesn't take off or just actually reverses back lower. But so far pre-market, we've already started to break out a little bit here to the upside. So this is one that I think I want to pay attention to here over the next week for potential breakout. Another one I want to take a look at is CHRW, C.H. Robinson Worldwide. So with the decline in airline traffic from passenger airline traffic, there's been a significant decrease in cargo space beneath passenger airlines. So air freight pricing have gone through the roof, and logistics companies like C.H. Robinson have seen continued increased demand for their logistics needs. They've recently just rolled out some new technology that allows anyone who's looking to ship things through air freight substantially easier without having to go through a fairly complex ordering system. Their new technology, I think, is going to be beneficial. And you also have this triple top here at 100. This triple top here at 100 looks like it has the potential here to break out here to the upside. This is one that I'm watching. The fact that it tried to break out above 100 failed and is now starting to trade back lower again, that is the opportunity that I see for a potential breakout. Same thing, if you're looking to play this breakout, I would use something like a call or a call spread, again, to try to limit as much risk as possible on a trade like this. So that covers what I wanted to share with you here this morning. I really hope that you guys find this useful in helping you understand where the current market is, how we currently look at the broader markets in terms of whether or not we continue to see further downside here for this market or potentially more of a contained and sideways moment here in the markets. So I really hope for those of you that are currently on a free trial to consider supporting us by becoming a member. That allows us to continue doing this every single week by going to trade.optionsplay.com/member. With that, I want to thank everyone. And at this point, because I have a few minutes and looks like markets are about to open up a little higher than where we closed yesterday pre-market, even though overnight it was a little higher, we've come back down quite a bit. If anyone has any questions, please feel free to type them into the chat window. Advice on the HD trade. So we did send out an alert this morning to close out on Home Depot. this is a segment of the market that I still am very bullish on and very strong on. If you look at housing numbers, extremely strong, but the timing on this just isn't right. This trade expires relatively soon. So from my perspective, we're about to enter that 21-day period of a credit spread. It's time to get out, even though it's at a loss here on Home Depot. And I do believe that there is potential upside here for this name, especially after this correction that we've seen. I actually think is an opportunity to go long, but the initial trade that we entered up here, not a great entry from that perspective. So time to get out of that trade. Would you reduce FXE holdings? I certainly think that the initial push here in Euro it's lost that momentum. As you can see, as it continued to push higher, we've seen this significant decline in momentum. That divergence is not constructive of further moves to the upside. So yes, I think that if you're long FXE, I think it's time to reduce some of those some of those holdings. Zoom, has pulled back here substantially from that move here. It's really hard to number one bet against Zoom at this point, and it's also very hard to not play for further upside. But it's just it's trading at crazy levels. I talked about Zoom and it was trading at it was at $100 when the first time I talked about Zoom on CNBC, and I thought it was a misunderstood stock and it should have been trading higher. But now it's trading at $390, and I asked myself, would I buy Zoom at $390? And the answer is no. I don't think it's valued there. It's basically trading just purely on the same hype that Apple and Tesla was trading on. So I do think that at some point this needs to come back to reality. I'm not a very strong believer here in Zoom. IBB is starting to move lower here. It really looks like this kind of almost like inverted head and shoulders. A head and shoulders formation here. So I'm not as constructive here on IBB. I think that you might see further downside here into that 118 area or so. SLV, same with gold, with dollar no longer continue to move higher. I no longer have this constructive play here on silver. Especially as you can see, momentum continues to move lower here as this moves sideways. That's not constructive, in my opinion, of a move higher here for silver. TWLO, I don't follow this company very much. I'm not 100% sure of their business model, but momentum's certainly starting to look weak here. I certainly think that you have a higher probability of a move here to the downside rather than higher. Thoughts on Apple trade? So I continue to be supportive of Apple. My views is that this is contained. We still haven't broken below that Monday low of 111. If we break below that, I would get out of the trade. But as of right now, I believe that the sell-off is contained, and I think Apple is likely going to trade within a range here. So I'm holding on to the Apple trade. What are your concerns leading up to the election? I'm actually going to be doing an election special as we get a little closer, as we have a little bit more visibility. It is something that's on my radar, but I do want to dedicate a little bit more time than just 30 seconds to that view. What's your view on Lennar? So, I'm a big fan of the home builders here. So, I like them. I love the fact that if you were able to get in on that low here, that would be a great entry point. I like DHI a little better than Lennar. In my opinion, this is just a stronger home builder. DHI also has, in my opinion, a better exposure to the suburbia market rather than, which is where we're seeing a lot of influx of people moving out of cities into the suburbs. So just from a financial perspective, from a fundamental perspective, I like DHI a little bit better than LEM. Walmart has really, come back down into that 134 level. This initial gain was from the TikTok thing, which, like I said, when it first announced, I said it doesn't make any sense to me. You know, also there was a lot of the talk about Walmart Plus, which I actually think is a great thing for Walmart. So I actually like the fact that you've gotten a pullback into this 137, 135 zone for a potential long-term play. But, you know, from my perspective, I wouldn't go long call options because Walmart is not a big mover. You know, yes, you saw this, but that was news driven. I think Walmart, I like it from a fundamental perspective, but I would be a seller of puts. Hopefully buying that stock into this 133, 135 zone and play for further upside long-term using the stock rather than options. Looks like we're about 1 minute from the open. Peloton is something that I continue to like. You know, I've owned the Peloton bike for 3 years now. They've recently just launched a new bike. Whoa, they're opening up at $98 pre-market. So opening up at 97. So, you know, as much as I like it, I don't like it at $97. I certainly don't like it at all-time highs. I would wait for violent pullbacks here as you got here back into that 73 zone. Those are the types of pullbacks, and you're likely going to see some of that volatility in stocks like Peloton. Wait for that pullback before you look for a long position. So thank you so much. I hope that you guys, again, find this useful in helping you set up your day. We'll send out the recording along with the slides after we finish here today. And I hope you guys have a great Friday. Happy trading. And I will see you guys on CNBC later tonight. Have a great day.